It's boring, but changing your lot ID setting could save you $169,000. This one setting right here, in many accounts, the default is the most expensive option in your brokerage account. Your broker may have chosen it for you, you may have never changed it. Same shares, same sale, one setting, possibly $169,000 difference. If you've got RSUs that vested across several years and you held them while the stock climbed, you're carrying something most executives don't know is there, a stack of tax lots, each with its own cost basis. And the order your broker sells them in, one setting you almost never certainly touched, quietly decides your tax bill before you made a single real decision. Here's what's actually at stake. You let those shares ride because you believed in the company and the upside was supposed to be yours. But when you finally sell, your broker reaches for the oldest, cheapest shares first, the ones with the biggest built-in gain, and hands you the largest possible tax bill automatically. On a $1.5 million sale, that default could cost $169,575 more than you had to pay from a checkbox. I'm going to show you exactly how one setting creates that gap, how to change it in about 5 minutes before your next sale, and what to do with the low basis shares you keep, because those aren't a problem. They're an asset most executives waste. And there's one specific situation where you should deliberately do the opposite of everything I'm about to tell you. Flip the setting back on purpose. I'll show you how to know if that's you at the very end. If you have equity comp and you want to make sure you aren't making mistakes, subscribe. That's the entire reason this channel exists. I'm Aaron Clem, founder of Inflection Point Wealth Management. We've helped executives coordinate equity compensation with the rest of their financial life. Most content gives this topic one sentence and moves on. It's worth 10 minutes and you're about to see why. Everything here is education and illustrative, not advice, not a stock pick. Stay to the end and you'll have 4 things: the exact setting to consider changing, the possible 5-minute fix, how to turn your low basis shares into optionality instead of a tax trap, and the one case where the opposite move is the smart one. Start with what's actually sitting in your account. Every time an RSU grant vests, it creates a brand new tax lot, its own cost basis, its own acquisition date. Vest 6 years in a row, you've got 6 lots, each with its different basis, stacked on top of the other. Now your broker has a default rule for which lots to sell first. For almost everyone, that is first in, first out. It sells your oldest lots first, and your oldest lots are the lowest basis. Now, your broker has a default rule for which lots it sells. For almost everyone, that default is FIFO, or first in, first out. It sells your oldest lots first, and your oldest lots are lowest basis lots, the shares from back when the stock was cheap, which means first in, first out is engineered to realize your biggest possible gain on every sale. I call this the FIFO Trap. It's not a scam, it's just a default nobody chose on purpose, doing exactly the wrong thing for an executive with appreciated equity. The alternative is a specific lot selection, or HIFO, highest in, first out, which sells your newest highest basis shares first and realizes the smallest gain. Same shares leave the account, completely different tax outcome. Let me show you how different. Take an executive, call him David. 60,000 RSU shares vested across 6 years. Stock's at $80 today. His oldest lots has a basis around $15 a share. His newest lots around $60. He needs to raise $1.5 million in cash, so he sells about 750 shares. Under the first in, first out default, those shares come out of his oldest $15 lots, and he recognizes $1,175,000 of capital gain. Switching the setting to HIFO, and the same 18,000 shares come out of his newest $60 lots, and the gain drops to $462,500. Same cash in his pocket, the setting alone moved his taxable gain by $712,500. At the top long-term rate plus the net investment income tax, 23.8%, that's $169,575 in tax, decided by a checkbox that can materially change the gain realized. And if you've got multiple vest years and a stock that's appreciated, that gap is sitting in your account right now, waiting for your next sale to either cost you or save you. Here's the part that makes this almost unfair. The fix takes about 5 minutes and it doesn't require me, a tax attorney, or a market call. Log into your brokerage, find the setting called cost basis method or lot selection, usually under account preferences or tax settings. Switch it from first in, first out to specific lot identification or highest in, first out. 2 rules that matter. 1, it has to be set before the sale settles. You cannot go back and repick your lot after the trade clears. The IRS doesn't allow retroactive lot identification, so the window is before, not after. 2, if you ever transfer the account or open a new one, Brokers often revert the first in, first out default. Check it again every time. The setting that could save you 6 figures resets quietly. If you've got a concentrated RSU position and a sale coming up and you're not sure which lots to sell or how to set this before you do, there's a link below to schedule a consultation. We'll look at your actual lots before you hit the button. I'll be honest with you about why almost nobody tells you this. It's not a conspiracy, it's a coordination gap. Your CPA files your return in April, and after the trade already happened. They report the lots, they don't choose them. Your advisor manages your portfolio, not your brokerage settings. HR handed you the grant and walked away. Everyone is standing next to this decision and nobody actually owns it. So it falls to the person who doesn't know it was theirs to make. You. That's one of the problems with how this industry handles executives. Nobody's looking at the seam where the brokerage, the tax return, and the equity comp meet. Now the obvious objection. Aaron, if HIFO leaves the oldest, cheapest shares in the account, haven't I just pushed a bigger gain into the future? Yes, and that's exactly why this matters more than it looks. That's low basis lots aren't a liability, they're a basis bank. Stored optionality you get to spend on your terms instead of the broker's. 3 ways to make a withdrawal. 1. Donate the low basis shares to a donor advised fund. You may be able to achieve 0 capital gains, full market deduction if you already give to charity. 2. Hold them for life. Under current tax law, heirs get a stepped up basis at death and the embedded gain simply disappears. 3. Sell them in a low income tax years, a sabbatical, a gap between rolls when your rate might be 15% instead of 23.8%. So highest in first out doesn't make the gain vanish, it parks it in the basis bank. So you can release it in the cheapest possible way instead of having first in first out, force it out at the worst possible rate. 2 ways executives blow this. First, they forget to set it before the sale, and once the trade settles, the window's gone. You can't reassign lots after the fact. Second, they let a broker quietly revert them to first in first out after an account transfer or a new account opening and never recheck it. So the rule is simple. Set it, then confirm it's stuck, especially anytime the account moves. And here's the one where you flip everything I just said. If you're in a temporarily low-income year, a sabbatical, between jobs, the year before a big liquidity event, you may want to deliberately sell your lowest basis lots, first in first out style, on purpose. Why? To lock in those gains while you're in the 15 or even 0% bracket. Drain the basis bank at a discount and reset your basis higher on everything you keep. Highest in first out is the default smart move, but in a low-income window, clearing your cheapest shares cheaply is smarter. The setting isn't always highest in first out, it's match the lot to the year. Let's wrap this up. One setting, 5 minutes, $169,000. The difference was never the investment. It was a checkbox your broker may have filled in for you and never went back to change. The mechanism in one sentence. Sell your highest basis lots first to shrink today's gain, bank the low basis lots, and release them through giving, a low-income year, or a step-up on a schedule, not the defaults. You make 8-figure calls in your day job. You shouldn't lose 6 figures to a setting nobody told you existed. So here's your one question. When is your next RSU sale? And is the setting changed before it? If you don't know, that's today's 5 minutes. If you want this mapped out against your actual lots, your vest history, your basis spread, which shares to sale and which to bank, that conversation belongs to my calendar. Link in the description, no pitch, just your numbers. And if you know another executive who's about to sell a big RSU position, send them this before they hit the button. 5 minutes either side of that trade may be worth $169,575. I'm Aaron Clem. See you in the next one.